Global oil prices saw a modest increase early Wednesday following a dramatic escalation in Middle East tensions and renewed geopolitical pressure from the United States. The market responded to Israel's surprise strike on Hamas leadership based in Qatar and U.S. President Donald Trump's public push for European nations to impose tariffs on Russian oil buyers. However, gains were tempered by an overall weak market outlook. As of 0033 GMT, Brent crude futures climbed by 35 cents, or 0.53%, to reach $66.74 a barrel. U.S. West Texas Intermediate WTI crude futures also edged up, gaining 36 cents, or 0.57%, to $62.99 per barrel. This follows a 0.6% rise in prices in the previous session, sparked by news of the Israeli military operation in Doha. Israel confirmed late Tuesday that it had carried out targeted strikes against Hamas officials residing in the Qatari capital. The Israeli government stated the operation was aimed at dismantling what it called Hamas's overseas command centers. Qatar's prime minister swiftly condemned the attack, warning that it risked derailing the fragile ceasefire negotiations currently underway between Israel and Hamas. The international response was swift. The United States, while reaffirming its support for Israel's right to self-defense, reportedly urged restraint and assured the Qatari leadership that such incidents would not recur on Qatari soil. This assurance appeared to ease investor fears of a broader regional conflict, leading oil prices to retreat from their immediate post-strike highs. Oil benchmarks initially surged by nearly 2% in the hours following the news of the attack but later lost momentum as diplomatic efforts gained traction. Market analysts noted that the limited price reaction reflects broader weakness in the oil sector and ongoing uncertainty about global demand. In parallel to the Middle East developments, U.S. President Donald Trump added further geopolitical pressure by publicly urging European Union leaders to impose tariffs on nations that continue to buy oil from Russia. Trump criticized what he described as Europe's energy dependence on adversarial regimes, and threatened to expand U.S. sanctions on companies that facilitate Russian energy exports. Despite the strong rhetoric, markets responded cautiously. The modest reaction in crude oil prices to this news, along with skepticism regarding U.S. President Trump's claims about potentially ramping up sanctions on Russian oil, leaves crude oil vulnerable to lower prices, said Tony Sycamore, an analyst at IG Markets, in a note to clients. Traders and analysts are watching closely to see if the current tensions escalate or are contained through diplomatic channels. There remains considerable uncertainty about the trajectory of oil demand, especially in the face of a weakening global economic outlook and rising inventories in key markets such as the US and China. While political risks have historically driven sharp movements in oil prices, the recent muted response underscores the market's current fragility. With fears of a global slowdown still in play, even significant geopolitical events may not be enough to sustain long-term price rallies without stronger demand fundamentals. As of now, the oil market remains in a holding pattern, delicately balanced between geopolitical flare-ups and economic realities.